Welcome to Fit, Rich, Sane, where we learn to be healthy, wealthy, and wise. I am Aditya, and I bring to you people who have researched related topics in extreme depth. You can listen to them and you can ask them your questions right here if you are listening to this live. To find out about the next live episode in advance, you can follow us on Twitter and on Telegram at FitRichSane. Thank you so much, everyone, for joining us. We are very lucky to have with us today Rohan Rautela from Random Dimes. As I have said before, Rohan can safely be called the king of alternate investments in India. By the end of this conversation, we will learn from him about various platforms from where he is earning great CAGRs. While we are fighting just with equity, he is earning fixed and great CAGRs from various alternate trading strategies. He has an experience of 20 years in derivatives trading strategies and portfolio construction, and Random Dimes is his effort dedicated towards alternate investments and innovative asset classes. Over the last few years, anything that I have shared on Telegram or Twitter about P2P, altcoin, fractional real estate, asset leasing, green investing, litigation finance. Most of my knowledge about alternate investments comes from Rohan. So, again, thanks to everyone, especially everyone from the FitRate Sane family, for joining in. It is honestly your constant support for all my ventures that is my biggest source of encouragement. Coming to the man of the hour, Rohan, just to give you a brief about what we do at FitRate Sane, we try to give all our audience actionable tips that they can implement today, along with details that will give them conviction about what we are sharing. We don't tell them too much about stuff that they can't use. It should be stuff that they can use today to become more financially secure. But to start with, let's talk about you. As we have seen, most people don't invest. Many of those who do so just for tax saving. And the ones who are really interested in investing at max go to stocks, trading, FDs, PPF, crypto, and the like. So, what made you get into alternate investments so deeply, Rohan?
Hi Aditya, thanks for the generous introduction. I really like the work you're doing, the kind of information you're providing to this community, and you're giving good practical advice. Because, like they say in theory, practice and theory are same, but in practice, theory and practice are different. So it is essential that you provide practical advice to your followers. Now, coming back to alternative investments, a lot of people get confused when they hear the word alternative investment. They think it is something very complex, something which is beyond their reach, and they should not even try to understand it. But alternative investment is a name which is given to anything which is not your equity and mutual fund. And if you think about it, a lot of people have been investing in alternative investments without even knowing it. Your parents might have given out, their flat to in leasing or to the tenants, which is essentially leasing. And even in if you go back in history, you'll see that a lot of ships used to be given on lease to sailors or captains. So that is also a form of leasing. You see a lot of people give out their cars on rent to Ola drivers. That is also a form of leasing. So alternative investment is not that complex. If you go through each product, you'll understand it might seem a little complicated on the outside, but it is no different from any other investment.
Thanks, Rohan. That takes away some kind of mystery from the term alternate investments because normally, whenever we talk about alternate investments, we get very perplexed. We think about big capitals and very different scenarios. But you put it very well when you said that it is just something that we are not doing regularly. So, before we get into the nitty gritty and the details, could you tell us a little about what exactly are alternate investments according to you? Though you have already mentioned it, but if somebody wants to start investing in something different today, where do you think they should start?
So alternative investment encompass all assets apart from your equity and debt mutual funds. It includes real estate leasing, it includes other asset leasing, it includes asset financing, uh, invoice discounting, revenue-based financing, and many other options like litigation financing. Now, the first question that will come to somebody's mind is why someone needs to invest in alternatives if they already invested in equity and debt mutual funds. That's a fair point. Anyone who's starting to invest, they should start with the most basic option, which is equity and debt, because that gives them a perspective about how capital market works, and that is essential to have. Otherwise, you will never be able to understand why different investment assets exist. Now, when someone has started a equity and debt journey, they'll reach a point where they will have a large allocation to equity and debt mutual fund. Now, at that point, it will come to mind of a lot of people that what has happened if the market tanks 20% from this level. For instance, if you have a 1 CR portfolio and out of that, if say 80 CR is in equity, now if the market falls by 10 to 20%, you end up losing 8 to 12, 8 to 16 lakhs. And a lot of people are not very comfortable with this kind of volatility. So, these, if you add a bit of a different asset class in your portfolio, which has a very low correlation with the broad equity market, which means that your portfolio will not be that volatile, and which also means that on a daily basis, you will not see that much movement in your portfolio, and which is essential for a lot of people like me. I do not like to have a lot of drawdowns or volatility in my portfolio because it gives me a lot of peace of mind. At the end of the day, I would suggest anyone or I'll advise everyone to invest some only in those places or in those amounts where you can have peace of mind, because that is the most essential thing when you're investing. Because if you don't have peace of mind, you'll make irrational decisions both in your investment journey and in your professional journey, and which will do you more harm than good. So that is one of the sole reasons I that is one of the important reasons I choose alternatives. The other reason I choose alternatives is because they provide cash flows. And as an investor, I like cash flows because when I get cash flows, I have opportunity to decide where I want to reinvest those cash flows. Could be equity, it could be debt. So I get in a way, a better power to invest in market when I want, when I have assets which are giving me cash flows. This is the second reason I choose alternatives.
That's fantastic, Rohan. So, one thing that I really took away from your answer here is that you talked about peace of mind. And this is something I keep saying on our Telegram group also, that I hate giving stock advice, like advice on which stocks to buy. Not because I feel I don't do enough research, but as you gave a very good example, it is very much possible that the same stock in the same period will give very good returns to one person and very bad returns to somebody else. That is why I don't like giving stock specific advice to anybody at all. But over the last sometimes, as some people have really asked me to do it, I keep sharing all my buy decisions. But that is also with a very strong disclaimer that my holding period can be forever and I might not tell them when I sell. So, as you said very correctly, this is the biggest problem with equity that giving advice is very difficult. And Holding through a drawdown is even more difficult. And that is why today we want to learn from you how we can get slightly more certain returns with alternate investments. Okay, so Rohan, with that, my next question to you is, and as everybody who has been on FitRate Sane for a long time can attest to, I have always said that before people start investing, they must do their life insurance, they must get their health insured, and they must develop an emergency fund. Also, they might have a rough idea of their goals. Then and only then can they start investing, and then they can decide whether they want to go for equity or mutual funds or direct stocks or whatever. So, in this journey that I feel starts with insurance, then emergency fund, then investments, where do you feel people should go for alternate investments? Is it before equity, or do you think there are people who can do well even without equity in their lives at all?
So this is an interesting question because a lot of people have this question that should I invest in alternative? So I'll add another part to this question. So one is when should someone invest in alternatives, and second, who should invest in alternatives? So like you rightly said, there are things which are more important, which every investor should cover before investing in other assets such as insurance, emergency fund, and they should start the journey with equity and debt. And they'll reach a point where they will have a large corpus and they want to diversify into other assets to reduce their portfolio volatility. So I think that is a point where they should start investing in alternatives. But another important point is you can't just start or investing alternatives one fine day and you know assume that you'll know everything. So when you start your journey in other assets like equity and debt, at the same time you should start exploring alternative assets. Even though you don't invest much, even though you just invest only for understanding it, and when you reach a point where you have enough capital and you have found knowledge, at that time you should start increasing your allocation to alternatives. Now who should do it? I think anyone who has a large capital and who are not very comfortable with the stock market volatility should invest in alternatives. I know there's some people who are very comfortable taking uh, the drawdown and it doesn't bother them. Then probably those people might not be very keen in investing in alternatives. But for someone like me, I like to have a balanced portfolio. I like to have some cash flows coming from my portfolio. I like to have low volatility. That's why I prefer alternatives. And it's you can always have a allocation to alternatives depending on your own risk appetite and only on your own um, view. So there's no hard and fast rule that you should have a 30% allocation or a 40% or 20% allocation. That depends on your comfort, one with the alternative asset class, and second your uh, uh, view on the kind of risk and volatility you want to take in your portfolio.
That is very well said. And in fact, for people like me, and I am sure there are many others like me, who primarily think of equity when they think of investments. So for us, this is a very good use for alternate investments because ideally we know that there are some times when we should avoid investing in the equity market because it is very high. But then, even for someone like me who researches their investments a lot, sometimes you still continue investing in equity simply because when I withdraw from equity, I don't have good options with decent returns to park my money for the short term. So, yes, this is a very important use for people like me. And secondly, this is one piece of advice I would like to repeat for everybody. If you think you will ever want to go for alternate investments, or anything else, start today. Even if you start small. Like Rohan said, start with a small part of your capital. But if you think that you will want to invest in it 5 years later and you start investing then, that will definitely not work because you wouldn't know the investment well. You will have to start today with a small capital and then you will eventually develop a bigger capital and a bigger and a better understanding later. So, Rohan, somewhere in your answer, you talked about bonds. How bonds can also be an alternate investment for people who don't normally go for them. So, is there any particular strategy where you would like to tell us how we can identify which bonds are safe? Like we understand higher the risk, higher the return. But how much risk should somebody take, and which bonds are slightly okay and which are not okay at all?
Uh, I consider bonds also as an alternative investment because normally people generally don't invest directly in bonds. They get indirect exposure to bonds through debt mutual funds. So recently, the finance ministry they mm, took away the tax arbitrage benefit investor had investing in debt mutual funds, which means that now debt mutual funds will be in parity with bonds. Now, what is the advantage of buying a bond over a debt mutual fund? So I'll tell you both the advantage and disadvantage. The disadvantage of buying a bond directly is it means you have to do more research. Second is debt mutual funds by virtue of their structure allow diversification internally because there will be 20-30 bonds in a debt mutual fund. It means you don't have allocation more than 2-3% to one bond, which prevent any large capital loss. Now, if you invest in bond, you're investing in one bond, which means if something bad happens, that can happen to that complete amount. So it is not only important to choose good bonds, but important to choose only invest a certain amount in one bond so that from a portfolio point of view, you don't over allocate to one particular bond. Now, the second thing is why is there an advantage in buying bonds over a debt mutual fund? One is obviously there is no extra fees which you pay on a debt mutual fund. If you think about it, bonds are generally a low paying asset class. They pay around 9 or 10%, and if you take 1% fees, so anyway, you're taking around 10% fees, 10% income out of that instrument. Now, you also understand that a lot of large insurance funds, PF fund, and other large treasuries, they have a mandate that they can only invest in AAA bonds. A lot of mutual funds also have this restriction, which means because certain credit ratings have given them a particular rating, people will be forced to invest only in those bonds, which create a demand, artificial demand for those bonds and reduce their overall returns because everybody wants them, right? And bond which are slightly lower in the risk curve, they're giving much higher yield, but they're less amount of money chasing those bonds. So they're slightly more risky than those AAA bonds, but the difference in returns is much higher if you are taking that risk. But to take that risk, you need to have that kind of knowledge about those bonds. And the good part is for a lot of these bonds which are listed, you get information, you get a lot of credit rating which reports directly available on internet, like the CRISIL report. You should read through it. You should go to the company website, read the annual reports, and then evaluate, does it make sense to invest in this bond. You have to look at certain criteria, kind of business the company is doing, what the financial numbers, and then you have to look at kind of leverage the company has taken, kind of mm, cash flow the company is generating. You have to see that is there any negative news about the company in the market. And after doing all those things, when you decide to invest in that bond, you also have to consider that the amount you're investing is in line with your overall portfolio. You don't want to end up putting too much money in one particular bond, because if something bad happens which you had not thought about, you don't want a big hole in your portfolio. These are the essential things when people have to uh, invest in bonds. And regarding the platforms, there are a lot of platforms you can find on my website randomdimes.com. You can find Altify, and then mm, Giraffe. These companies list bonds, even Grip list bonds, and you can choose the best bond after your evaluation.
So, what I understood from Rohan is that Diversification is always important, and while going for a bad rated bond is definitely not okay, we also don't always need to go for the very best rated bond. Just one question with this. You said that we can look for the credit rating of the bond. Is there any particular agency or website from where we can check this?
So, I mean, a lot of bonds are being, rated by CRISIL. So, if you just type up name of the bond, you can just type CRISIL rating. You'll find it. You'll find a report. So, for every bond which is issued, it gets rated by a credit agency, and they do a detailed analysis on the bond. What kind of liquidity the company has, what kind of cash flow the company has, what kind of debt to equity ratio the company has. So these what kind of NPA, if it is a financial service company, it has. So these things will help you to analyze a bond.
So, in a way, the credit rating agency is doing the research for us and then rating the bond. And Rohan, to make it easier for everyone, any particular platform you would recommend that people can visit to invest in bonds?
So I mean, if you go through my website, I mean, I generally and I have reviewed many platforms, and some of them I'm personally using. I use Wintwells. I've been using Altify, uh, and I've used Giraffe. So I use multiple platforms. For me, more important thing is the kind of bond that is being listed. If it meets my criteria, I'm happy to explore any platform, because if you see, for bond, the platform is secondary. For the bond, uh, the issuer is of more importance, unlike maybe some other asset class.
So that's a very good point. That the platform is secondary and it's basically the company whose bond you are investing in.
Right.
Rohan, my takeaways from bonds from you is that one, we should diversify even within bonds. Secondly, while as I said earlier, we should not go for a bad rated bond, but the best rated bonds will often have lower yields. And of course, the first step is checking the credit rating. And as far as possible, we should also go through the financials of the issuing company.
Right. So, for instance, if you're getting a saving bank or a FD, for 7%, there's not much advantage taking a 7% bond, right? Doing so much, hard work evaluating.
Correct.
Probably you can just put it in your saving bank only. Because now the tax advantage has gone, right? So there's not much difference.
Very true.
Very true. So, Rohan, coming to a very hot topic today. So, as far as I understand, most of the alternate investments that we talk about are debt investments. The only exception, in a way, is cryptocurrency. Now, specifically Bitcoin. So, do you have an opinion about Bitcoin? Should we buy more? Should we hold? And apart from Bitcoin, would you like to suggest any other cryptocurrency that we can trust or that you bought?
So see, this question I would answer it more from a portfolio perspective. So if you look at a cryptocurrency, Bitcoin, Ethereum, and all the other maybe top altcoins like Polygon, like Matic. So what you see, think of it from a risk and reward perspective. What is the most you can make in a, let's say, a portfolio of, let's say, top 20 crypto? If your thesis goes right, if what we think the world will become in next 10 years, right, probably 10x 20x from here, maybe, right? It may be like the next internet, because we already seeing web3 companies, we are seeing decentralized finance, we are seeing a lot of things happening, tokenization, we are seeing people are moving into the digital world, NFTs are picking up. So there is
Right.
a huge upside which is possible. But if you look at the other end, there's a possibility that none of these things materialize and maybe go to zero. So there you have a left tail where you can lose 1x of your investments, right? And you have a right tail where you can make, let's say, 10x of your investments. Both things are a possibility, right? I cannot say with guarantee that this is going to happen, but I feel if you put let's say a 1% of your portfolio or a 2% portfolio from allocation to a diversified crypto coins, there's a chance that you can your portfolio can do well in the long run. And that's why it's important to only put a small amount, because the chances that two become can become zero point 0.5 also, and even if it becomes 20, it can first become zero point 0.5 and then 20. So you do at no point when you're holding crypto, you should not sell off just because of panic, right? What will happen is, let's say if you put And that will, when will that happen? When you have holding a very large portfolio. Let's say if you put 10% of your portfolio in crypto, and which is, let's say if you have 1 CR portfolio and if you put 10 or 20 lakhs in crypto, what will happen if it corrects by 40-50%? You will panic and you sell. That should not happen. Probably what should happen, you should buy at that level, right? So probably you should have, right now you should have only 2%. Maybe if crypto connects 70-80% from here, probably you can have 3.5, 4%. That's it. But because if things goes right, then you can make, do really well. But if things doesn't go right at all, then still you don't lose much. That should be your approach. Because see, there not just the crypto performance, there are other things also, like how government is, rules can change, its regulatory rules can impact crypto, holders in India. So one thing I advise people is do not trade on crypto, because with the 1% TDS, it's not worthwhile. So I recommend, if you just should just buy and probably hold it in a a hard a cold wallet, or a hardware. That is the best thing. Put small amount and just forget it, right? Because if you look at it on a daily basis, then you will always have either a FOMO or anxiety.
That is indeed very insightful for us. And one thing I would like to ask you over this is I don't know how many messages you're able to go through on our channel. One of the things that I have always suggested to everyone is index funds. And one of the most important reasons for that, like, of course, I believe that index funds will outperform most active mutual funds, but that is a different thing. One of the prime reasons that I love index funds is they help us get over analysis paralysis. Even when someone decides that they want to invest in an active mutual fund, when they start going through the types and the categories and the number of mutual funds that are there in India, many people just give up and end up not investing at all. So I feel that index investing is also a very good solution to that analysis paralysis also. Similarly, is there any kind of platform for cryptocurrency where a mutual fund has been created by some company, or you can just copy what some other investor is investing into, and you can just copy that and get equivalent returns? Is there any such platform?
See, the thing is, there are platforms, but most of it, them, would be available for people who are living outside India. So, because with the new rules which are coming in, in the budget, there's certain requirements that you have to pay tax, at source, collection at source, and all those things, which will make it really tricky, exploring opportunities outside India for Indian investors. So, but if someone is staying out of India, I mean, there are options. There are option like Economy, and there are the platform which you can just copy index of cryptos. But still, I suggest people not to have a lot of exposure to platforms, because crypto, one of the biggest thing is the platforms going down, like FTX. So you don't want to be at the receiving end. So a cold wallet is a safest bet. Probably you can create your own index, just buy maybe the top 20 crypto in small quantity and keep it in a cold wallet. And probably when market corrects 20-25%, you can add on dips. And I think that is more than sufficient. I mean, you do not have to do too much analysis over that.
That sounds like a very good strategy that people who are interested but are not able to decide can just invest in the top 20 currencies and see how their portfolios go from there. And another very good point that Rohan mentioned is that when we are investing in a risky asset like cryptocurrency, we are already taking the risk of the asset class. Now, we should not combine it with the platform risk also. We should, at least, as he said, store it in a hard wallet so that even if a particular platform is to shut down, we don't face that risk at least. I think what you said matches greatly with what I try to convey to my audience at Telegram as well. Okay, so I think the next most talked about alternate investment that has picked up over the last few years is P2P lending. In fact, not many people know that even the 12% Club by Ashneer Grover, BharatPe, that is also basically a P2P platform. And if I'm not wrong, you have tried and invested in various P2P platforms available in India. So, do you think this is a good way to invest your money? And if you're starting with P2P, if somebody is starting with P2P today, Which platform would you suggest, and how do you think somebody should start with P2P?
So yeah, I mean that's an interesting question because P2P platform is something which was the first alternative investment available in India, and I
Right, that's
started
how I also
trying.
started.
Yeah. I started, back in 2018, and there were a few platforms at that time, and so I mean, so I had a mixed experience. Initially some of the platform did well, but then the COVID thing happened, and I realized a lot of these platforms didn't have a collection team which could actually go and get the money back. Probably they were just technology focused companies, right? And the other
Right.
thing I realized that these platforms allowed you to choose borrowers. And what happened, a
Hmm.
lot of people, they end up choosing investing a lot of money in one borrower, and if that borrower defaulted, their portfolio was in a bad shape, even though platform returns were okay. So I think after 2021, a lot of these companies have revamped themselves. So instead of the investor, they giving opportunity investor to choose borrower, they ask investor to put in the money, and they diversify across multiple number of borrowers. And I think in the last 1 year, 1.5 years, I have again shortlisted a few platforms. I mean, like one India P2P, Lendbox. These are a couple of platforms which I use it. In fact, if I think a lot of people might be using Credmint, that is again a partnership with Liqui Loans. So again, the underlying is a P2P platform, Liqui Loans. So you can directly also create an account on Liquid Loans, and that makes more sense because then you can actually look at your portfolio directly rather than looking at a black box.
Rohan, your knowledge of platforms is really exemplary. I mean, it clearly shows that you are personally investing and then only reviewing each platform. Because anybody you talk to in the finance field, they will be able to give you overviews of various investment options. But giving overview of platforms is something very few people are able to do. So hats off to you for that. And one question that I actually should have asked you a little earlier, just for the benefit of our audience who is absolutely new to this, could you give us a brief of what P2P exactly is and what it does?
So P2P, which stands for peer-to-peer lending, in simple words, is basically a way to connect a borrower and investor using technology. So if you think about it, what does a bank do? A bank, when you put money in a saving account, uh, the bank is basically borrowing from you. They borrow at what rate? 4 or 5. Now they are borrowing at 6% because the interest rate has gone up. And these banks, lend to borrowers who needed money. They lend at 14%, 16%, 18%, 20%. At whatever rates they can. Depending on the riskiness of the borrower also. So they borrow at 5% and they're lending at 15%. They make a good 10%. That is the basic business of most banks in India, be it banks, be it NBFC like Bajaj Finance. That's how they make money. Now P2P is an innovation. They say, okay, why do we need a bank in between? If we can provide the analysis of all the borrowers, the investor can directly invest in those borrowers and get a higher return. Instead of 6%, they can make 14%, and we take 1% fees. I mean, theoretically, that is a very good model, but not if all the P2P platforms were able to do the right credit analysis. So that's why some of them did well, some of them didn't do that well, and still, an evolving field. Right now, I'm using a couple of platforms which I feel are doing satisfactory, and I think over a period of time, we'll find maybe other platforms also.
Okay, so Rohan, as we were talking about platforms, now if we talk about the 12% club that is being offered by Bharat Pay, and a common mentality, I think, across the world is that if something is being offered by a reputed company, we feel that there is practically no chance of a default or there is very little risk. But then, when I think of it from my point of view, even mutual funds, equally mutual fund investors, target roughly 12 to 14% from their equity funds. And now we have Bharat Pay offering a guaranteed 12% in the 12% club. So, do you think this is something that can be a large part of our portfolio if we are happy with 12%? Or are there some risks that we are not able to see on the surface?
That is a very interesting question, and I think it is not fair to compare, a 12% club with equity mutual fund, even if the returns are same. See, the reason is a lot of people confuse risk with volatility. 12% club has low volatility. Equity has high volatility. Does not mean that 12% club is less riskier than equity. Equity is something which has a history, a very long history of 50, 100 years, and it has a behavior, right, which you can predict from the history, right? So when you say it gives 10 to 12%, you that is based on what is seen in the history, and it is a diversified portfolio of companies like Reliance, companies like ITC, which are not going to shut shop tomorrow, right? So this is something you have to keep in mind, that equity might be volatile, but over a period of time, companies generally make money, and there things happen, bad things happen, but that will be a small part of the portfolio. But overall, in the long run, companies will make money and equity will grow. Maybe in the short term, there can be a lot of volatility. On the other hand, Bharat, 12% club is basically a platform, and 12% club is basically kind of a interface they have created over a P2P platform. Basically, what they're trying to do is they trying to use their own brand power to get more customers, to onboard more customers. But below that, it is a P2P platform, right, where you are the investor and there's some borrowers. These borrowers could be shopkeepers and all. They could be It could be well diversified, but again, you know you can put a lot of money in an equity portfolio. You can put 30% of your wealth in equity portfolio. It's not going to go anywhere. Probably it can 30 can become 15 maybe, but again 15 maybe will be back to 30 maybe in 2 years, 3 years, 4 years. But Bharat Pay or 12% club is relatively a newer thing, and you do not have the history to be confident enough to say that nothing bad can happen. So maybe a 2% allocation is good enough, but maybe 20% I would say no, right? Because a lot of things can happen, a lot of bad things can happen which you are not sure of, right? It is basically run by a company which itself is not making a lot of money right now. It's still not profitable. Even if it is profitable, things can happen, right? Which in their business model, things can happen. Probably how they are doing due diligence, behavior of the shopkeepers can change, like in pandemic and all. So keeping that in mind, it is not advisable to put a lot of money. Probably a small amount of money, that's fine, but not a lot of money.
Rohan, I love the way you keep talking about creating an entire portfolio as opposed to just constantly thinking about the highest returns from a single asset or from a single asset class. There is something that we discussed on our group a little while back, that even if there is a single stock in your entire portfolio that goes, let's say, 100 times, but if it is a very small percent of your entire portfolio, it might not affect you a lot. Also, on the other hand, that stock might go to zero also. But if you have diversified well and it is not a huge portion of your portfolio, again, your overall portfolio will end up doing well. And secondly, I remember when I was taking a personal finance session once, and as always, I was suggesting index funds to people. Somebody asked me that I'm so confident about index funds on one hand, but on the other hand, I'm also saying that if there is anything that is giving a return more than a bank FD, then there has to be a risk involved. And as you mentioned at the beginning of this answer, this is what I also explained to them at that time, that the risk is there. But the risk in index funds or maybe very large cap mutual funds and is more volatility than an actual default. In something like a P2P company, there can be an actual default by the borrower, and that will reduce your entire return, maybe even reducing it lower than an FD or from what you get would have gotten in a savings account. In case of more proven instruments, or in Rohan's words, instruments that have a more proven history, the risk is more volatility than anything else. And I think volatility for people like me is more easier to take care of and to digest uh, than an actual default. An actual default is what actually hits us bad. Now, Rohan, since we are talking in the last week of March, could you talk a little about tax loss harvesting? Is it worth it? Like, there's some effort, it's not the easiest thing to do. So, with that effort, is tax loss harvesting worth it? And if yes, what is the best way for retailers like us to do it?
Yeah, so I think some of the things are pretty simple, pretty, it's a slam dunk. You can, for instance, in equity, you can book up to 1 lakh without paying tax. So that is something which can be done quite easily. You can just book the profit, buy another mutual fund. These things, I think everybody can do and should do. They'll save around 10,000 directly. Then if you have losses, some losses, if you want to offset those losses, you can do. I think beyond a point, the incremental effort is not worth it unless you have a large portfolio. I mean, you should think about it in terms of, this rejigging, how much actual, money you are making out of this rejigging. If you think that the actual, inflow, out of all this shuffling is not much, then I think you should, not do it. You can just do the basic things, booking what is the profit you have, maybe, and not go into, trying to optimize everything to the perfection, if it is not, giving much return, and then some things which people can do right now is, because the right till 31st March, anyone who has invested in debt funds will get the indexation benefit. So probably if you wanted to invest in debt funds, I think this might be the time you can just, put in some of the money in debt funds right now, and take benefit. So I think this is something which a lot of people can do, and that will save more tax than tax harvesting.
Thanks for reminding us of that, Rohan. Rohan, coming back to you and your prime topic, actually coming back to the basics, actually, when somebody like me thinks about alternate investments, as I told you earlier, I also started with P2P. But then now when I look through to start with your website, there is, to name a few, there is P2P, there is fractional real estate, there is invoice discounting, there is revenue based financing, there is farm investing, there is asset leasing, there is litigation finance, and so many other things that I guess you have personally invested in and experienced. So, if somebody wants to start today, where do you think, not investments, starting investments comes later, but if somebody wants to start studying today, start researching today, which platform or which asset do you think they should start researching so that they will not get overwhelmed and they will understand something and they will be able to invest some basic capital to see how it goes?
Uh, yeah, I think a great starting point would be to analyze your own current corpus, and your investment you're looking to make in these platforms. The reason I'm saying this is because, see, some certain platforms have a minimum, let's say, a ticket size of 1 lakh per deal. And let's say hypothetically, let's say someone has a 5 lakh or 10 lakh corpus, it doesn't make much sense, investing 1 lakh in a deal, right? Because if that deal goes wrong, you don't want to lose maybe 5, 10 to 15% of your portfolio, right? So there are platforms where you can start with 1,000 rupees also. There's like P2P platform like India P2P, you can start with 1,000 rupees. Then there are platforms, where you can start with 5,000 rupees. So again, depending on how much you intend to invest and how much is your current portfolio, you should take that as a starting point. So there's no point, let's say, targeting fractional real estate platform which has a minimum of 25 lakhs if you don't have that much, capital at hand, or you don't have a current portfolio which has that much allocation. So that is one of the starting points. But I would still say that you can explore these platforms. Probably you can, see most of these platforms signing up is free. I think especially a lot of my links on the platform, you get the discounts also. So most of it is free. So you can just explore these platforms even if you don't want to invest. So what will happen? You start learning about these deals. What kind of deals are there on the platform? Maybe not now, but maybe 2 years down the line, you have more capital. At the time, you'll not get overwhelmed when you have to invest. You'll already know that this is a good platform, these are good deals. Maybe I didn't invest maybe a couple of years back, but now I can do that. So that's how I would advise someone to approach it.
So at this point, I think I should tell everyone that if you keep following Rohan's website, his blog randomdimes.com, Rohan also keeps updating you about which platform has the newest and the best deals as of today. If a new platform or even an existing platform comes up with a new deal or a new investment, you will get an update from his blog. So make sure you subscribe to it. And Rohan, one question that I have for you. There are so many questions that a retail investor has related to alternate investments, and it is generally very overwhelming to like if you invest today. As you said, you very rightly mentioned that if you want to invest today, you should have started a few years back. You should have, and if you want to invest a few years later, you should start exploring today. But if you want to invest today, it is definitely overwhelming for a retail investor. So, have you ever considered managing other people's portfolios?
Actually, that's quite an interesting question. I thought about it. So, but what I felt is, like unlike equity mutual funds or debt funds, where you can give people a sacrosanct number like allocation, or you can just give a name of a 2 3 funds. Here, each deal is so different that how do you convey to people that you invest in this particular deal only, you don't invest in this deal, and you have to actually spoon feed people. So, and that doesn't help the purpose, because at the end of the day, people should also know and understand what kind of risk they're taking, because everyone has a different risk appetite. So what I did is, I started publishing my monthly portfolio in terms of how these platforms are doing, how these are deals are doing, and why I invested in a particular deal or something. So that one gives them more information about, how these platforms are doing, and also help them to analyze deals. So that I feel in a way is in a way, helps people to make informed decisions. I mean, I'm more than happy, if someone is getting started in alternate, they want to have a short call, want to, understand from my experience, which platform I feel are good. I do it for a lot of people who they keep on emailing me, or, on reaching out to me on Telegram. I'm free to, help them. But, advising, because everyone has their own unique risk appetite, your own capital, and each deal is different. So it's not actually quite feasible to keep advising on individual basis.
But then it is very kind of you to actually respond to individual investors who have doubt about this. I know this because even I had a doubt a few years back, and you gave me a very elaborate response that really helped me take my decision. And now, Rohan, you talked about risk aspect. So before we sign off, let's talk also about the risk of these investments. As ultimately, as you said, they don't have a history. There is no government backing. And while the newest platforms, they make it very easy to invest in these avenues, but it's very difficult for most people to judge which investments are good and which aren't. So, what is the risk aspect here?
I think there are two risks involved in most platforms. The number one risk is the platform credibility, and second is a deal specific risk. So basically, let's say the chances the platform itself is not doing the correct thing, they're not performing their fiduciary duties, or the platform who's running the platform has certain ill will or intentions which are not in the best interest of the investors, right? And second thing is, a platform might be good, but there can be a bad deal on a good platform also, right? There can be a bond which you invest, and you end up losing the money. So first, for the first case, what I suggest and what I do is, I invest only a small, whenever there's a new platform, I invest only a small amount. And I have conversation with the founders, I have conversation with team, I look about the platform on the regulatory websites, I look at the team on the LinkedIn, do my own due diligence, and then gradually I start small, first understand, the returns the platform are generating. Does it make sense? The kind of documents platform is sharing, and the information they're providing. And then when I get more, confidence on the platform, I gradually increase my portfolio with the platform. That, and I think I suggest that to everyone whenever they're starting a platform, start with a small amount, and ask questions, keep asking questions, keep looking out for information, maybe on LinkedIn, on MCA website, about, can Google about it, the funding and all that, who the founders are, the background. This will help you to get more information about the platform. And second is a deal going bad. I think that is something. One, you need to do a due diligence of each deal, each bond, each invoice that is on the platform. Just read about it. There's so much information they provide. Second is, like I said earlier, only invest, only an X percentage of your total capital in one deal. One deal going bad should not, totally destroy your portfolio returns. So that's important. So try to keep allocation to a deal, in line with your overall portfolio allocation, and do your own due diligence of the deal. So that is essential. If you follow these two parts, you're generally good to go. And you realize, you start investing, over a period of time, 3, 4, 5, 6, 7, 8, 9 months, you'll start becoming, better at, evaluating these things.
Wow, Rohan. Your method of research and the way you take care of your money is something all of us should learn from. And I hope everyone has learned what's your next step towards investing in these avenues. For somebody, it can be more research. For someone else, it can be investing a small amount and then seeing how it goes. But there are four key points that I would like to reiterate that I have really taken away from Rohan in the last 1 hour. The first is that nothing matters more than your peace of mind when you're investing. And this peace of mind can be increased with research and with more studying. If you're not very comfortable with something today, you might feel more comfortable with it if you start learning about it slightly more. Secondly, don't think too much about each investment. Think about each creating a portfolio and where each investment stands in that portfolio. Third thing, we should learn from how much research Rohan does. It is your money. You have worked very hard to earn it. Do your research, do your due diligence about each company, each investment, and then you invest in it. Then you put your hard earned money into it. And the fourth point is learn to differentiate between risk and volatility. For somebody, a 20% drawdown might suit better if there's a chance of recovery. But for somebody else, a 20% drawdown might not suit them at all, even if they're sure that the market is bound to go up again. So it depends on each and every person and what they like and what they can sleep comfortably with. These are the 4 points that are my key takeaways. And when you go through Rohan's website, randomdimes.com, you will again see the amount of research he has put and the level of self analysis he has done, and it will really boggle your mind. Follow Fitrich Sane on Twitter and Telegram for many more such enlightening conversations and daily actionable tips. Thank you so much for being with us. Stay in touch. Before making any investments, research more, consult your advisor. It's your hard earned money. No one will care for it as much as you do.